One of the hardest things you have to do along the home buying journey is decide what mortgage product is going to be right for you. And by that, I mean, is it a fixed deal, a tracker deal, a variable deal? Are you going to go for an offset mortgage? It can be overwhelming. And that's why in today's video, I'm going to break that down for you. Hi, I'm Sam, a mortgage expert in the UK. And on this channel, I help people like you understand what decisions to make when it comes to buying a house. Do me a favor, like and subscribe. It does more for us than you will ever know. Let's get to it. So look, when you get a loan to buy your home, you're going to be charged interest on what you borrow. It's not free money. You do have to pay them back. And if you look at a mortgage offer, it is a ton of cash along the way. Well, this is known as the mortgage rate. Now, there are two main types of mortgages. Now, firstly, you've got a fixed rate. Now, this essentially is where your interest rate stays fixed for a period of time. Common sort of years are 2, 3, 5, 7, 10 years. There are even lenders that will fix it for the entire term, but it's important to understand which one. The other one that you have is a variable rate, and that means that every month, potentially, your interest rates can change. There's a little bit more risk, so let's break them down. So let's start with a fixed rate mortgage. Most common, majority of people go for them this day and age. Now, the interest rate stays the same for the length of time of the deal, and so do your monthly repayments. So once the fixed rate ends, and you need to remortgage. If you don't remortgage, then you're going to go on to what's called the standard variable rate. And this is the highest rate of interest you'll be charged by your bank. So the pros of a fixed deal, well, as we can see, you're fixed, your payments are fixed, your interest rates are fixed. It is the easiest way to budget over the next couple of years. You're not going to be affected by rising interest rates. So let's say Donald Trump sneezes and the interest rates jump up overnight because you're on a fixed deal. That means your payments will not be touched by that point. Another great point is you can often overpay on your mortgage, and you can overpay up to 10% per year without a fee. With a fixed deal, you'll have a payment of, let's say, £453.70, and it's nice and easy to round them up to £500, and you know exactly what's going to be overpaid on your mortgage and how that's going to shorten your term. Now, like all these things, there are some downsides as well. So with a fixed mortgage, it means that it can be quite restrictive. You can't really make any changes during those sort of 2 and a 5 year fix. You can't just go to your bank and say, I want to change that now to a 5-year fix. You're going to have to break your deal. And if you do that, then you might have some early repayment charges to pay with that lender. The other thing is if interest rates go down and you're in a fixed deal, you're not going to benefit from that as well, because from day one, you've agreed with your lender, this is exactly what I'm going to pay towards my mortgage. So next we have a variable rate. So a variable rate is where your interest that you pay on your mortgage each month can go up and it can go down. Now there's a few ways that this can happen. It can be in line with the Bank of England base rate if you're on a tracker rate mortgage. It can be in line with the discount off a standard variable rate from a lender if you go for a discounted product. If you're on the standard variable rate, then a lender can wake up one day and potentially just say, yeah, we're going to shave off 0.5%, or we need to add on 1% to our standard variable rate. So the cost of the borrowing might become more expensive. So it means that some months you might pay more and some months that you might pay less. So it can be a risky business. And as I said earlier, one of the pros of a fixed deal is that you know your mortgage payments are set for a period of time. With a variable rate mortgage product, whether that be a discounted rate, a tracker rate, anyway, let's go and break those mortgage products down. And let's start with a tracker mortgage. So a tracker mortgage product follows another interest rate, and that's usually the Bank of England's base rate plus a margin for the lenders. So for example, if the base rate goes up by 0.5%, your rate's going to go up 0.5%. You'll usually get an email straight away and the interest rate will happen within the next couple of days. But what they want you to also understand is that the lender will add a margin on top. So your mortgage product might be the Bank of England base rate plus 0.5% or plus 1%. So as that increases, so too do your payments. Now, if the rate goes down, then your mortgage payment is going to go down too. With this sort of mortgage product, you're not going to be tied in as much, so you can switch deals to other providers because it's a common place where they don't come with early repayment charges. And there are usually less limits on overpayments as well. But most of them this day and age are still sticking around the 10%. Now, the downside with the tracker rate mortgage is if the rates are going to go up, or you feel like they're going up, or they actually are going up, then your payments are going to keep going too. So it's a good point to keep a track of that. Go with your gut feeling, and at some stage you might want to consider fixing it in if the economic scale is showing that they're going to be going upwards. The next one is the standard variable rate mortgage. Now, this is the interest a mortgage lender uses for their standard mortgage loan. The rate can change at any time, and you tend to find it is the most expensive one. I've seen these at 9, even 10% over the last 2 or 3 years. Now, the pros of this, you've got complete freedom. You can leave at any time that you want to. There's no penalties or anything like that, and no limit on it making any overpayments. If you want to make a 20% overpayment on your mortgage, you can go ahead and do that. But it is the most expensive rate and it can change at any time. So have that in mind. And it's not commonplace for people to stay on a standard variable rate mortgage unless their mortgage balances are pretty low or unless it forms part of a wider planning process for something else. Then we've got a discounted rate. Now, this is a discount on the lender's standard variable rate and only applies for a set period of time. A bit like a fixed, really. So it's a discounted rate for 2 years or 3 years. Different lenders have different rates, so it does pay to shop around, and a bigger discount doesn't always mean a lower repayment. The upside to this is the rate starts lower, so your monthly payments are going to be smaller. If the lender cuts its standard variable rate, then your payment's going to go down too. But it is hard to budget like any variable rate mortgage, as the lender can raise this whenever they want to. If the Bank of England base rate goes up, your discounted rate might go up too. Not always, but it could do as well. And you might have to pay a fee if you leave before the discounted period ends. So can be quite a good saving, might cause more headaches, but that's why it's important to plan. Then we've got an offset mortgage. So an offset mortgage links your mortgage to a savings account with the same lender. Now this means you won't pay interest on part of the mortgage equal to how much is in the savings account. Now usually your savings account won't earn interest. Instead, you're paying less interest on the mortgage account that you have with them. So for example, there's 100 grand in savings and a £200,000 mortgage, you're only going to pay interest on that 100 grand. The upside is you're probably going to pay your mortgage off quicker than a standard mortgage, and you can also withdraw your savings if you need to, but that's going to adjust the interest that's charged on your mortgage account. The downside, you obviously don't earn any interest on your savings. You're limited to the rates of the lender because you have to have the account with them, your current account or your savings account, and your mortgage account with them as well. And finally, with an offset mortgage, there is a chance that you could earn a better interest rate with an alternative lender somewhere else altogether. So as I said before, you're restricted to them lenders. And there you have it. There's the different types of mortgage products explained. If you're a first-time buyer, typically we tend to find people go for a fixed rate mortgage unless criteria and other things in the background drive us towards a discounted rate or a tracker rate. But as I said, do your research, have a look at your budget, let's sit down, look at the overall financial planning of where you want to be now and in the next 5 years, and that'll help you make sure you're choosing the right products. As I said before, if you've liked this video, please give it a like and I'll see you next time. So we've got Mortgage Rates Explains. This is our new production video clicker to get our clap. And as you can see, production is Sam Fox ME, standing for Mortgage Expert. The director is Emma, cameraman is Chris, and this is the date. We haven't got the shot, take, or scene now.